Hey, this is Blake with How to Trade Options, and today we're going to talk about buying puts. Buying a put can have multiple purposes, and the two we're going to talk about today are buying a put for income and buying a put for protection. You can purchase a naked put if you're bearish on the stock and want to make money on the drop of the stock price. You could also purchase a put to protect the stock that you own. It serves as an insurance contract, so if your stock continues to go downward, you're protected. We're going to look at a few examples, and this morning we're going to take a look at GameStop for put buying purchases. So to recap, there are two main reasons why you would want to buy puts. First of all, if you're in a GameStop position and you have 100 shares of GameStop because you wanted to ride this wave. Well, essentially, I mean, this year has been really crazy with GameStop, and so I'm thrilled that GameStop has provided us with this great example of how technical analysis is key and how fundamentals make absolutely no difference in this world. And as a technical trader, you can make money on any particular stock. It's fantastic. So we have this crazy volatile stock, and right now it is trading at 181.75 as of market close yesterday. This is the 1 year to date chart that we have here. And as you can see here, the most recent activity is we have a little bit of a downtrend, okay? Now, let's say that you decided to get in at 160, okay? You bought 100 shares of stock at 160. Your exposure is 100% of those shares. So if it goes down to zero, which it could, your exposure and your maximum loss is going to be that $160 times 100 shares. But in this situation, you've read the technicals and you've said, okay, the downside possibility for GameStop is huge, right? It could drop back down to pre-pandemic numbers, and we could be back to, $16, $15, $17 in a day. Just like it shot up to, 300, 480 one day, it could shoot back down in a heartbeat. And you want to, however, you still want to hold on to your shares because you think that there's a possibility that the Reddit traders decide to get together and decide to buy GameStop and take it to the moon again, take it to 400. Well, buying a put is a great strategy for protecting your downside with a little bit of cost and continuing to hold the shares for the possible upside. So you have downside protection and you have upside exposure. It's a wonderful strategy for a highly volatile stock. Okay? So let's take a look and see what that would look like on our profit and loss calculator over here. Okay, so you have 100 shares of GameStop, and we decided to go ahead and put that in with a evaluation price of 160. If the only way you make money is if the stock goes up and you sell the stock. Okay, you lose money, the stock goes down, obviously. So in order to limit the possible loss exposure if it decides to shoot down to 10, you want to buy a put. Let's take a look at what that would look like. So you need one put, one contract. And we could take a look out. Let's go with the monthlies close by. And remember, the shorter expiration you have, the cheaper it's going to be because there's not a lot of time left. It's going to expire worthless very soon. Okay, the longer expiration away you have, the more it's going to cost, but the benefit lasts for much longer. So when you own something, you typically want to have a longer expiration, but there's a balance in choosing your strike dates, your expiration dates that your options expire on. And it's typically more benefit to choose the monthlies in order to pull in the best bid and ask and premiums and all that. So let's say your exposure for this is $10, and if GameStop goes below 150, you think therefore it could continue to go further and further and further south. Okay, so you want to protect your downside if the shares of GameStop go down below that 150 strike. Now, because of the volatility in this stock, this particular, to buy a put that is roughly a month away, pretty expensive. But your exposure on it is huge, and so you want to be able to combine one put with the stock that you own. So what we have here is our stock position. If we add the put to it, and in order to be able to do that, you click Control and left click. It then combines the two positions and will update your profit and loss calculator to say, hey, now you have a floor that says the maximum you can lose is going to be at that 150 spot. So at the end of the day here, you've protected yourself from continued downside and says that the maximum you can lose is the 45.80, as opposed to the maximum exposure you have is 100% of the cost that you have of the 16,000. Much, much, much better risk-reward ratio of having the stock and then owning a put to protect yourself from the downside. So you have eliminated a massive amount of downside there. What you're doing is buying insurance. Okay? If the stock price goes down, the value of the put that you own increases. And in this situation, it increases by the delta for direction. For every dollar the stock price moves, the value of your put goes up or down by 26. Okay? For every day that goes by, you have 96 theta. And so for every day that goes by, theta is time, and your time is reducing the value of your puts that you own. Now here we have 26 days to expiration. So you have a good amount of time for your options to be valuable and help you out.
I would even go simpler than that. Maybe even like, so what's going to happen, like if the stock price goes down, the value of the put goes up, so that it's kind of like leveling it. You know what I mean? Like, not even too complicated, but just
absolutely,
like
absolutely.
Fourth grade version of like what's actually happening with
that's right. Okay, so if the price of GameStop goes down, the value of your puts go up, and you can then sell the puts that you own and make money off of what you have bought. Okay, if the price of GameStop goes up, the value of your puts will go down. However, if in this example you own the stock position, and at the same time the value that you have purchased in the puts is offset by the increase in the stock price in the 100 shares that you already own. You bought this because you wanted insurance, not because you wanted to make money in this particular example. Now, let's take a look then and say, okay, I don't own shares of GameStop, But I want to make money on GameStop because I think GameStop, going back to our chart here, I think GameStop is garbage. And I think that fundamentally GameStop is going to go bankrupt. I don't care how many board members they have on their that they appoint on their new board. I don't care what's going on. These guys are never going to make money because I'm going to buy my games on the internet and not through GameStop, and I never will. So I've read this chart. I think this stock is very overvalued, and I think that we are bearish on GameStop 100%, and I think it's going down to zero. So you've got a couple options on how you can trade that. And so here are your options for your options, right? And number one, the classic way of taking care of GameStop is the item that's been in the news so much lately, is you want to short it, okay? All right. And in order to be able to short the stock, it's the exact same thing, except opposite of buying the shares of stock. Okay. Now, in the shares of stock, your profit and loss is based off of you bought something and you could lose 100% of that something, right? So your exposure is $16,000 in this particular example because you bought GameStop shares at or at $160. If it goes up to 200, you could make $4,000. If it goes down to 100, you could lose $6,000. But you can only lose the amount you put in on buying the stock. The difference between buying the stock and shorting a stock is the exact opposite. Okay? You have borrowed money from your broker. You have then said, I am going to sell today, and I would like to buy tomorrow. Let that sink in for a minute. I'm going to sell today, and I'm going to buy it back tomorrow. Now, in a typical buy low, sell high, you have to have the price of the stock go down in order for you to make money on a short. However, if you are borrowing and you have yet to have bought the shares of the stock, your downside potential and your loss potential is actually the opposite of owning the shares of the stock. And at the end of the day here, that means just like GameStop could go to $100,000 per share, and you could make that profit. If you short it, it could go to $100,000 per share, and then you would have to buy it at that point in time to limit your continued exposure. To me, that is the most dangerous thing you can ever do. And that's why experts say, in order to short something, you need to be the smartest guy in the room. And the short sellers really have to be confident and know the fundamentals are what they are. With that being said, that is how you could short a stock in any case. So shorting GameStop with the volatility and which direction it's going in, we don't know, we don't care. However, that's a risky business, shorting GameStop right now. Okay? But I'm still confident in my forecast, and I still think that GameStop is going to go down. I'll give you a better option then. Hey, let's buy a put. Okay? Now our risk-reward ratio is actually fixed. If you buy a put, you can make money for a stock going down. If you buy a put, your risk is only the amount that you paid for it on the front end. At any point in time when you're buying an option, the debit that you have spent on day one when you make that purchase is the maximum amount you can lose. For some reason, people think that options are risky. I think that's ridiculous. Shorting a stock is risky, but buying a put is not. It gives you a limited amount of risk with a major downside benefit of if the stock plummets down to $10 a share. So in this situation, if you own a 150 put, for every dollar that goes down, that GameStop goes down tomorrow, you make money. And in this case, you make money by $26 for every $1 it moves. So those are the two main options for how do you want to use puts effectively in your trading. Buying a put outright without owning the shares of stock is a really good option for how you can short a stock without actually shorting the stock and having the exposure that you have. And in addition to that, if you own shares of stock and you would like to have protection against the downside, you can buy a put.
Thanks for watching this video. For more free educational content on trading options, check out the playlist on our channel. As always, like and subscribe if this video helped you, and we'll see you soon.